Hi, my name is Kristen. I'm a certified financial planner and founder of the financial planning firm Brooklyn Plans. I'm very excited to be here with you for a Financial Literacy Month exclusive financial wellness tips in uncertain times. Today's edition is on federal student loan payments and interest freeze. You may have heard that there is a freeze on payments, and we're going to walk you through how it's determined, how and when you can get it, some FAQs. We'll wrap up with pro tips and what you can expect from us for the rest of April in future editions. And this content is sponsored by DailyPay. They are a pay experience company. They help employees control the timing of their pay, monitor their earnings, and build up savings. Right now, they're offering free next day transfers to their users. Check them out at DailyPay.gov. Let's talk about your federal student loans and what options you have. So what is this payment and interest freeze relief? So first of all, it is for borrowers that have federal direct loans. So we're going to go over how you can know if your loan is federal and direct in a little bit. But we'll first just give you the summary. For 6 months, there is no payments for federal student loans, and there's no interest being accrued. So that brings us clear through the end of September that there are no payments due, and the awesome side benefit of that is that they're also not building up interest. Usually, if you stop making payments, the balance continues to grow because of interest accruing, and that is not the case. So your balance will essentially be frozen, as well as your payments during this time. There's also a little known benefit that not that many people are taking advantage of, so we're not going to go into it into too much detail for our purposes today. But employers are also able to now deduct $5,000 provided to employees for payments of their student loan. So it makes student loan payments similar to a 401k or healthcare benefit you might expect from an employer. But this is temporary. It will have to be extended in the future to be made permanent, and so far not very many employers are using it. So it's not something that many people have access to at this time. How is the payment and interest freeze determined? Well, it is based on anybody who has a direct federal loan qualifies. It's automatic. And the way to know if you have a direct federal loan is usually it's very clear from your loan statement or when you log in online that it's through direct loans. And the name of your loan would be something like direct subsidized loan, direct unsubsidized loan, direct plus grad loan, or direct grad plus loan. You'll see direct normally in the title if you have direct loans. And what that means is that it's the newest program of federal loans offered by the government as of 2010 or later. So if you took out loans in the last 10 years and didn't before that date, chances are you have a direct loan as long as it was a federal loan. Now, if you're still not sure, you can go to studentaid.gov and you can check out in the registry all of your federal loans and what loan program they're with. So if they're direct, if they're FFEL, which we're going to talk about, if they're Perkins, which we're also going to talk about. So you can check all your federal loans on studentaid.gov. Now there's also private lenders that service private loans, and for those, you'd want to check your credit report. We're going to go over that too. So if you check and you have an FFEL loan, which stands for Federal Family Education Loan, now there's a little bit of a two-pronged approach here. If you have an FFEL loan that's being held by the government, so at the U.S. Department of Education, then you are covered and you don't have to do anything to qualify. You're automatically qualified. If you have an FFEL loan with a private lender, that does not automatically qualify. So you have some options. One is to consolidate to a direct loan so that your loan is held by the federal government, because you do have that option. But we have a huge stop sign here because you should do that with caution. If you're currently qualified for loan forgiveness through an income-driven repayment plan and you consolidate out of that private lender held FFEL loan to a direct loan held by the government, you can lose all of that time towards loan forgiveness. So if that's not the case, then you can go ahead and consolidate. It's a good idea because you'll qualify for a program that you otherwise wouldn't qualify for that will allow you to not pay your loans through the end of September. If you are in the middle of a payment plan towards loan forgiveness, like an income-driven repayment plan, then you can request forbearance and keep your loan there. Or if you're not, you can ask to apply for income-driven repayment if you're having trouble making payments on that loan. So you have a bunch of options if you have FFEL loans to make your payments easier, or even nothing, because if you're unemployed, then you can request an income-driven repayment plan based on $0 of income, which would qualify you for $0 payments, which is essentially the same thing that everyone else is seeing through this payment and interest rate freeze, except without the interest rate freeze. But the payment would be frozen, which is what everyone else is seeing. So if you have private loans, you can check if you're not sure who your lender is, then you can check that on annualcreditreport.com, and you would have to get in touch with them directly. They are not covered by this legislation requiring direct federal loans to postpone payments and interest rates. However, the word is that they are working with people. They don't have to, but it's in their best interest to try and work with people, because the magnitude of the people facing problems paying loans is so widespread that they are offering options, as I understand it, but it's on a case-by-case basis. It depends on the lender, so you just got to reach out to them and try to work something out directly. If you have a Perkins loan, this is another type of federal loan. However, it's not a direct loan. In fact, most of the time it's held by the institution you actually went to school at. So for these, the federal government has allowed the institutions to provide forbearance for 3 months based on economic hardship without requesting any additional documentation. So it's worth checking with your institution to see if they are participating in that. And in general, Perkins loans have up to 3 years total forbearance available. So this time of 3 months that's been kind of pre-approved without documentation would go towards that total, but you also have some options if you've got a Perkins loan. When and how will you get it? Well, you've already gotten it, or should have, if you have a federal direct loan. Servicers were asked to postpone all payments, and they had until the beginning of April. So it is retroactive, though, through March 13th. So you may have made a payment after March 13th and before your servicer implemented the freeze, in which case you can ask for a refund. And in fact, that is true of any payment that you make on your student loan between March 13th and September 30th of 2020. You can ask for refunds if you paid a dime to your student loans, because there's nothing due. And what do you have to do to get it? This is the best part. This rarely happens. You don't have to do anything. The servicers are implementing this, and they are required to implement it on the borrower's behalf. You don't have to ask. You don't have to call. They just anticipated that the need would be so great that it would overwhelm call centers and application processes. So they just shut it down and are not taking payments at this time, and should have updated their systems. If you log into your account online, it should say there's no payment due until sometime in October. All right, so you have questions. We have answers. First question is, what if you're going for loan forgiveness? Will this affect my eligibility? So if you're on an income-driven repayment plan, depending on the plan, these cover income-based repayment, revised pay-as-you-earn, pay-as-you-earn. These plans have a built-in loan forgiveness when you have made enough qualifying payments between 20 and 25 years, depending on the plan of making qualifying payments, the loan is forgiven. These payments that are not due during this time will still count as time in those programs, as long as you were in it before and continue to meet the requirements to be on that plan. So the one that I mean in particular is public service loan forgiveness. You have to still be employed by a qualifying employer, which would be like a nonprofit or a government agency, in order for this time to count. So that's where it might be a little bit tricky if you lose your employment and for that reason are not able to pay. and don't have to, then this time would not count for public service loan forgiveness because it's tied to your employment with a qualifying employer. However, it would still count for any kind of income-driven repayment plan, which is actually a prerequisite to public service loan forgiveness. You have to be on an income-driven repayment plan, and the time will count for that. But I have heard of somebody being misguided about that question and told that they had to pay for it to count, and that is certainly not the case. So you do not have to pay during this time, and don't let anyone tell you differently, because it is required to count for any qualifying programs that lead to loan forgiveness. All right, what about your credit? Will it hurt your credit if you stop paying? No, and this is because the way that it's technically being conceived of is that you are making payments and the payment due is zero. So you are on time and paying in full every month during the time that your student loan payments are frozen. What if my loan is defaulted? And this is a great question, and I never thought I would say this, but this is a great time to have a defaulted student loan. And the reason for that is because in order to get a loan out of default, you have to do something called rehab or rehabilitation, which involves making 9 consecutive payments on that loan of an agreed upon amount with a collections agency that services the loan once it's defaulted. And after that time, it can go back to a current status, and it can also remove some of the negative information associated with that default from your credit report. Now, right now, you would be able to make 6 qualifying payments during this time of $0 and only make 3 of those 9 payments at an actual dollar amount. And it's less time. You'd have to also deal with a collections agency, which is usually not a positive experience for most. So this could actually work in your favor if the loan is already defaulted and you haven't rehabbed it and you're having any negative consequences of that, like wage garnishment or tax withholding. All of that activity has also been stopped for these 6 months. So you're in a good position to go ahead and rehab it if you haven't, or if you are already, you're also going to be in a good position to do it with less money out of pocket. Question 4, should I keep paying my loans if I'm in the position to? This is a really good question because loans are being universally stopped from payment required and there's nothing due until October. But the question that follows is, well, if you haven't lost employment and you're feeling comfortable to keep paying, is that a good idea? And the answer is a little complicated, but it could make sense if you don't have accrued interest existing on your loan. Then paying this money right now will go directly towards the principal. So usually when you're in a regular repayment situation on a student loan, part of every payment you make goes to interest and part goes to principal, which is actually what knocks down the balance of the loan. Right now, if you don't have an interest balance, which some student loans do, and that's a whole technical, complicated other story, but if you don't have accrued interest on your account and all you have is principal, then it could make sense because you can make a dent in it a lot faster than you would when part of every payment that you make is going to interest. So we're going to talk about a pro tip we have for you based on this new situation with your student loan options. If you are in fact in a position where you would like to keep making payments on your student loan, what I suggest is that for this time, for the next 6 months, instead, you make that payment to a high yield savings account. And that payment would accrue a little bit of interest for you. And at the end of 6 months, but before September 30th, remember that's like the deadline, so it would have to be sometime before then in September, you could take all of that money and just put it towards your student loan, plus it would have grown a little bit in interest. Or if paying your student loan is not a priority right now, and that is an okay position to be in for a lot of people, it may not be, you could take that money, save it, or put it back in your wallet. But it's a great opportunity if you're in the position to keep paying to pretend that that payment's still happening, but pay it to yourself, earn the interest on it, and then you can decide what to do with it come September 30th. Great. Well, thank you so much for joining me today. This has been a Financial Literacy Month exclusive financial wellness tips for uncertain times. I'm Kristen, certified financial planner and founder of the financial planning firm Brooklyn Plans. And this content was sponsored by DailyPay. You can check Brooklyn Plans out at brooklynplans.org, DailyPay at dailypay.com. And tune in next time. Every week in April, we're bringing a new video or two to help you and your family navigate these uncertain times. Thank you so much. Take care, be well, and stay safe.